Well, good morning, everybody. It's Wednesday, right? Hump Day. We're all excited about that. I'll start with an introduction. My name is Mark Howell with Alpha Capital Management Group, and this is my business partner, Ian Campbell, also with Alpha Capital Management Group, and we are 401k advisors. So we are new to this plan. We've been around for about 6 months now, and we're going to explain to you what we've done so far. And we're going to explain what this process is moving forward. We're going to talk a lot today about your 401k plan. And by show of hands, who wants to make more money? Yeah, okay, that's unanimous. And that's a great thing, because that's our goal and our purpose, right? So we're here to help you make more money. We're going to show you some things as far as some tools and some investment advice on how we can help you do that. The goal, of course, is to have a dignified retirement, right? So we know from doing many of these types of sessions that there's a tremendous amount of anxiety in our country. So not only in this office, but every parts of Denver, every parts of Colorado and the U.S. that we work with clients that there needs to be a lot of vacation, there needs to be a lot of financial wellness. We normally don't talk about this stuff. When you go home, you're at the dinner table, you're out on the weekend doing something, we don't focus a lot on money management. We don't talk a lot about budgeting. We don't talk a lot about what our retirement is going to look like. We know anxiety exists. We see a tremendous amount of anxiety and people that are nearing retirement. So we really want to do one thing, and that is to coach you to a better path, right? So it's all about discipline, and we're here to be that coach for you folks. So since about January, here's what we've done. Your plan is with Fidelity, right? We know and understand that. You log in, you see your accounts. Sometimes, and most of the time, the balances go up. Sometimes they go down, and we know that the markets move, right? So we understand as investments that things go up and down. Our goal is to make sure that we stay on a disciplined process. We want to make sure that you understand your investments. Are they aggressive in nature? Are they conservative in nature? What's my menu of choices? How can I be more educated? So that's our goal. We're going to be your coach, right? We are going to give you advice in your best interest. We're not here to sell you a darn thing. We want to make sure that you trust us in the fact that if I ask Mark or Ian a question, that they're not going to have some sort of a hidden agenda to sell you life insurance or to buy an annuity. That's not our role. That's not our purpose. Our goal is twofold. One, we're going to meet with the company level HR departments and financial people to make sure that the plan with Fidelity is running right, that it's low cost, that the investments are being monitored and looked after, and that all of these things as a benefit are doing what they're supposed to be doing. Secondarily, it's things like this. It's coaching in meetings, in webinars. It can be all the way down to one-on-one meetings. So you have access right now from this day forward to call us, to email us, set up an appointment. We'll spend time with you, literally one-on-one, because a lot of you aren't going to ask questions that are personal in nature, especially in a session like this. So these are all value adds that are different. Many of you got notices in the mail earlier this winter with investment changes. A lot of investment changes happened. So what we did as advisors, the first thing we did is we looked at all of your mutual funds in your 401k plan. And there were some really good mutual fund choices that you had, but they improved. What we did is we switched a lot of them out, and we put lower expense ratios on some of these better performing mutual funds in your 401k plan. And that really was a massive improvement. You probably didn't see much. You got the notices. Sometimes we throw those things in the mail because we get those, and that's kind of what we do as individuals. But that was a major improvement that Ian and I did, and with help with the investment committee here at Carbon, that those investments improved. And you're going to see better performance, and you're certainly going to witness lower expense ratios. So the cost of owning those mutual funds went way down. We also kind of arm wrestled Fidelity as a provider, and we got them to lower their costs as well. So we've been able to do some good things. And ultimately, moving forward, we want to make sure that you're making the most out of your 401k plan. You understand it, and we're going to coach you through hopefully some concentration in retirement here. So any questions at all so far on who we are, what we do, why we're here? All right, very good.
We're going to cover some basics. Some of this may be just a refresher for some of you. The details of the plan, who is not enrolled in the plan, we're going to talk about how to get enrolled in the 401k plan. But to start with eligibility, there's no length of service requirement, and there's quarterly entry dates. So the next entry date, if you're not in the plan right now, would be July 1st. The following one would be October. If you said no between those periods of time, you have to wait until the next window. There is a company match that's a benefit to you. It is a 6% match. So if you put in 1%, you'll get 1. That's where that schedule is. You would want to put in at least 6% of your contribution to get the full benefit. If you're doing something less than that, you're leaving free money on the table, essentially. If you do something greater than 7%, then you're going to get that full benefit of that 6% match. And then the contribution limits for 2019 did get bumped up from $18,500 last year to $19,000 this year. If you're over age 50, you can put an additional $6,000 catch-up contribution. So you have to do the 19 first, and then you can put in an additional $6,000 for a total of $25,000. It allows those people that possibly haven't saved enough earlier on. It's another window that they can put in additional tax deferred income. Any questions on the company match or the eligibility?
This is also referencing 401k and the Roth.
Correct. So you have both pre-tax and Roth contribution options. So it does not matter what you put in. If it's pre-tax or Roth, you get the company match based off of what your percentage is. So make sure you're doing at least 6% to get that full benefit.
Any further explanation on Roth? Or go ahead with your question.
So then the limit of 19,000, is that for both?
Just your contributions. It does not include company match. Very good
No,
question.
no, I mean, is it 19,000 for the 401 and the Roth together or each?
So pre-tax and Roth money types, it's combined total. So you can't have 19 in one, 19 in the other. You'd have to have a combined total of $19,000. And that's your annual contributions.
Does anyone have any questions on how the money is taxed between Roth and pre-tax, how that whole thing works? Is everyone clear on that, or should I explain it very quickly?
Sure.
Yeah. So the government's going to get the tax from you, right? They're not going to let you skate by forever. So with the pre-tax contribution, which is the normal way, you're taking the tax advantage up front. So if you make $1,000 and you decide to put in $100 in your 401k plan, the government's taxing you on $900 of gross earnings. So those monies went in untaxed. When you retire and those monies come out, Uncle Sam is right there waiting with hand out. You're gonna pay tax on those distributions. Now with Roth, it's the flip opposite. You're gonna put in $100 after tax, money's gonna grow, you're gonna hit age 65, 70, you're gonna pull money out, it's all yours, because you paid the tax up front. So does that help? Yep. So some people do both. Most of the time, younger people start pre-tax, most of the time younger people start with Roth because they're not in a high tax bracket. They don't need the deduction current year. And then as earnings get higher and, all of that, then they'll switch to pre-tax later in life. But every situation is different. So,
and you can always change it too. So whatever you decide this year, you can change it mid-year, you can change it next year, whatever. There's nothing that you decide today in the future is set in stone. You have full flexibility of changing your contribution rate, traditional versus Roth, and also the investment choices too. So going through, for those who haven't logged into Fidelity's website, their website's really easy to remember. It's 401k.com. You can go to that website, hit enroll now, or register for a username and password. Pay attention to your stuff. It's just like your bank account. If you've got Wells Fargo, Chase, you know your login. Your 401k is just like that. With enrolling in the 401k plan, there's a couple steps. You can go to the website and hit enroll now, or you can call Fidelity and their customer service team can help you with that as well too. So a couple options. Clark, if you don't mind hopping to the next page, I'm just going to show you. There we go. So this is a snapshot of 401k.com or Fidelity's landing page. I just wanted to reference 2 points. In the top right corner in this black bar, it says register as a new user. So for those who have a 401k plan contributions going into it, you're just not aware of your login, click there. If you'd like to enroll in the 401k plan, there's a link in this first little bullet or a little bubble in the middle where it says enroll in your 401k. You can click that hyperlink. It's going to bounce you out to another landing page that verifies your identity, like name, social, date of birth, to register for a username and password. It's just a couple steps to do that. So
how many people have actually logged online and went through some of these tools and resources that they have as far as some of the programs and videos and white papers? Okay, good. Have you all found that it's been pretty helpful in its education? So financial wellness is a big topic in firms. So here's a statistic for you. Years ago, health wellness was kind of at the forefront. So you'd have a nurse call you, and you know, maybe you get dollars put in your account, who knows. And if you live healthy, you're going to be at work and you're going to be more productive. We're finding out that people are financially unhealthy, if you will, and there's as much distraction at work as your wellness side, on your health side, right? So financial wellness is a big part of it. We're finding people are very disruptive. They're checking their balances. Maybe they're getting a credit call on their cell phone because you're behind payments and so forth. So we want to get people kind of past that. And so by tools and resources, your website is going to be geared towards helping you through some of those things, as well as ourselves. So we want to be part of that financial wellness resource for you. Okay, so so the statistic part of that is people are spending about 5 hours a week on a 40-hour work week on their own time with financial matters that are on company time. So just so you all know, we're aware of it.
So this is what's called an asset allocation guide. For those who are here in the meeting, we've got a printout of that. This is our guide to that investment selection help. Mark and I are financial advisors. We're gurus in this arena. We have put together the investment menu for you. That's how those investments are there. We screened roughly 20,000 mutual funds and narrowed it down to about 30. You've got some phenomenal performing funds in there, all low-cost institutional funds. Some of the expense ratios are down to 2 basis points or 0.02 of 1%, so extremely low, almost free in a way. So you have options to pick from, active and passive. But there's 30 of them to pick from. Some of you may have a hard time of understanding what to pick from, what's appropriate for you. This is our guide to help with that final decision of how do I deploy my money. The way this is broken out is into 2 scenarios. The top larger rectangle is going to be more of a hands-on approach. You're going to pick and choose from that available fund menu. And it's broken out into 5 columns, from conservative risk tolerance all the way to an aggressive risk tolerance on the right-hand side. For those who are in their 20s and 30s, tend to be an aggressive column. 40s and 50s will tend to be in that moderate aggressive column. And then folks in their 60s would be in that moderate column. Individuals that are in or retirement or nearing retirement could get into more of a conservative, moderate conservative role, but we want to make sure you're taking appropriate risks throughout your working career when you can afford to take risk, not at the last 5, 6 years of your working career. So the hands-on option, we update this guide every single quarter. The newest one will come out in July, around the 15th of the month, and we'll come out and slightly update these numbers. There's a reason that there are certain percentages in some of these funds. All of these funds are great, but there are certain areas like large blend or little exposure in small blend or little exposure in international funds that we feel is better to be in at this given market than other areas. All of these choices are good, but with our due diligence and research and analysts of these sectors, we feel this is the best case scenario of having the highest possible return if you want to be hands-on. And we update this quarterly. The ask of you is if you're going to follow the guide, all you got to do is log in once or twice, 3, 4 times a year, maybe.
We lost sound.
What's that?
We lost sound for a minute. Can you repeat what you just said?
Yes, so you can go in and out of any mutual fund. There's no cost of going out any of the investment choices at all. So you could trade them every single day if you wish to. There's no penalties to going in and out of any of the choices. So the ask is just to pay attention to the guide if you want to be in front of what we deem is the best possible opportunity from a performance and low risk. The second option is going to be more of a hands-off approach or autopilot mentality, and they're the target date funds. And the way target date funds work is you would find out what year it will be when you reach age 65. And that's going to put you into one of these middle ranges. The target date range is in that middle column on that bottom rectangle, and it'll plop you into the range. And that's going to be your most appropriate target date fund. and that would be a sole investment choice. So you'd go 100% into that target date fund. And the target date funds work in the way that those who are younger are going to have a bigger year because they're going to retire later. And those who are younger are going to be more aggressive. And then as every 5 years, they de-risk over time. The bottom four, the bigger the year, 45 to 60, is similar to an aggressive column. The next middle ones, the next four from 2025 to 2040, is going to be similar to that moderate aggressive column. And then folks that are in the present year, that 2020 fund or the retirement income, are nearing retirement or in retirement, and it's going to be more of a 50-50 moderate risk tolerance. So they start out aggressive in that 80 to 90% level, and they de-risk every 5 years, ultimately getting to about 50-50 balanced portfolio. So you've got hands-on, hands-off. The third is you're free to do whatever else you would like as well, just how you would probably be doing it before today. You can pick and choose whatever investment. We just wanted to help provide a roadmap and some advice and education around what we feel would be appropriate for each of you to invest in, given those investment choices. So, Mark,
yeah, just maybe by a show of hands, from the initial time that you enrolled in your 401k plan, has anybody actually moved their investments around, or are they just where enrolled at? Seems to be more of a nod of heads on the latter part. So we find that very, very common. We do recommend that you become a little bit more in tune with your investments. So in order for us to help you, you have to first understand that if you were to call us and we're in our office tomorrow and you say, hey, I really think that moderately aggressive column looks good. Can you just change it for me? And my answer would be no. In other words, I can log into the Fidelity website as your advisor. I can see everything about that investment that you've done, but I can't change anything. Fidelity doesn't allow us to, and that's just the 401k world. So that means that you have to log in and change it yourself. There's a little tab on there that says, I want to change my investments, and people do this all the time, believe it or not. And our goal and our help is that if you were to follow one of these models, we believe that we can put you in front of performance given our market research, right? So that's how we're going to help you make you more money. So don't be afraid to make changes. Again, as Ian mentioned, there's no cost to do it, and there's no time frame. So we would want to welcome you to do that, and to do it once a quarter, because we're going to update this once a quarter. So when we send out a new sheet, you'll get access to it. It might be on your company website or however it's posted and shared, maybe in the lunchroom. You just simply have to log in and spend 5 minutes and change it. All good to go until the next quarter. So for a few minutes of your time, 4 times a year, you can have this hands-on model. The fire and forget, hey, I get that. Some people are just like, just put me in a target date and let it ride for years and years and years. That's okay too. It's just called strategy B. So anyway, that's our help to you. This is not normal. Normally, to get investment advice, you either have to have an advisor that you work with in your own household, which is fine. We're not there to disrupt that. Again, we're not selling you anything, but this is very new, and we think this is a tremendous value add for us to be associated with your plan to help you out. So any questions at all on this investment model?
When is the new one coming out?
So it comes out the 15th after the beginning of the quarter. So like July 15th, October 15th, January 15th, April 15th is when we get the new data, and it's normally about a week after that. So call it another 21st area. Yeah, so mid-July. And not necessarily saying that the percentages may change. So if the economy is kind of in the same area and market news is trending the same way, we may not have a change for July, but there may be certain areas depending on how the data comes out and forecasts and stuff. So, and not necessarily saying you have to change it every 4 years. We may not even change the numbers from quarter to the other quarter.
So let's segue into what Ian and I believe is going to be very, very important information when we talk about what do the markets look like? Everyone in here has got an opinion. Everyone that has called in has an opinion about what they've seen on the television, what they've heard on the radio. Trump trade talks, right? It's in the news. There's some things in the Middle East that are happening. There's stuff happening at the border. We've got, obviously, always the national deficit. We've got an election coming up, right? These are all things that we know. We talk, and it's going to create an opinion as to how you feel the markets are going to do. Is it good? Is it bad? Are you doomsdayers? Are you thinking that the markets are going to crash like they did in 07, 08? What does it look like? What is our best guess if you were to ask Ian and I what this market looks like? So we like to talk and start first at what the economy has done in the recent years, right? So more of a 30,000-foot view. So we know that the markets go up and down on a daily basis, but if you look at from 1996 to 2018, we get a much clearer picture over the course of, say, 20 years than we do from day to day, right? So we had a nice little a run up in the market in the late 90s, and then we had what was called the tech bubble. Does anybody remember that? We're all in Denver. We kind of remember that. And then they ran up again, and then lo and behold, we went through the Great Recession in 2008. So it kind of created a letter M, right? And then since 2008, guess what? Just kaboom. For 10 years and greater, yes, there's little dips in there, but for the most part, the general trend is we've been on the longest bull cycle we've ever seen in market history since the markets opened way back 100-some plus years ago. So that in mind already leads me to think that, okay, when is this going to end, right? Because we know that we go into recessions. The next slide is actually going to show that. When is this bull run going to end? And how does that mean, and what should you do with your investments in your 401k or your IRAs or your TD Ameritrade account? So we want to help you with that, in that level of understanding that market cycles do happen. If you were to look at 2018, and this is actually through May 31st, so we're only 3 weeks out from its current data, we've seen in June that this has already bubbled up again. I mean, we're already at market highs, and so the economy still seems to be producing. We believe that likelihood is going to happen for about another year. In other words, we've still got some runway in this economy. Things could change, though. The things that could change are a breakdown in China trade talks. That's a big one. We certainly have an election a year, 3 or 4 months from now. That could change how things are going to look as well. Those are the two big ones. But China trade is probably the most prevalent. The interest rates at the Fed, that's something that always seems to affect the economy. We've had rate increases for quite some time. There's actually talk in July that they're going to go down a quarter point. And if that does happen, if rates go lower, that's going to drive our economy further and extend the rally. So we're always watching these things, and we're wanting to be mindful.
And one thing to add, just to that observation, people were paying attention to the newsroom September, October, November, and even look at their account balance in December, it was down a lot. What that move was from September, the top of this peak, down to here almost at the end of the year. And then automatically, within the month of January, it went right back up and set new highs. So that short period of time, within 3-4 months, if you're buying, there's nothing wrong. If you're retiring in 2-3 years, yes, it's much more relevant to you. But for those who are 10, 20, 30 years out from the retirement picture, you've got another picture like that rather than just one of these all the way back down. Markets do tend to rally back after a large decrease, as you can see historically. They do rally back, and we'll show another slide about that. But I just wanted to show some observation of what we saw in September and October of last year. It did it again recently, kind of in the middle of this year. We saw this spike down, and like Mark mentioned, we're all the way right back up at market all-time highs with some of the China concerns.
What was the significant change that was happening that caused that to shift?
Right here, there was multiple factors, like Mark had just previously mentioned. This is the same market news. So.
It is the market news that happened in January. With the relative economy, interest rates are low, oil is still relatively inexpensive, wages are growing, inflation is in check, our GDP in our country is hanging around 3. There's so many tailwinds in our economy, and when you see a decline, like we did in November, December, the market responded like, well, there's no reason for this to have happened to have gone down, so therefore I'm buying back in. So the flood of cash that came into the markets just drove prices right back. So it is on data, but it is a lot of emotion as well. Here's one thing I can tell you too. When you look at the markets and you see a big down day, 300 points in one day in the Dow, we all freak out. It's like, holy cow, why did this happen? So the media likes to attach a piece of news right away. It was because Trump tweeted this, or it was because a missile got fired in Korea, or whatever the case is. The media loves to attach a piece of news, and they love the negativity of it all, because negativity sells you to watch that channel. We don't watch TV because of the good news. We watch TV because someone got ran over, or the markets went down, or there was a flood somewhere. That's what drives all of that stuff to television and radio. So you have to be really emotionally in check when you hear and read and see that stuff.
Next section, I think would be good.
I get going on the market too, so.
So one chart that we wanted to highlight was just what we think as a future outlook. For those who are 5-10 years out from the retirement picture, now is important to understand what risk you're taking in your portfolio. Are you aware of what investment choices are in your account right now? If not, go log in, give us a phone call. You can reach out to us at any time. There's no additional charge. We can set up one-on-one calls, set up meetings as well too. So feel free to reach out to us at any time that you would like. But with that, we wanted to provide you some guidance of what we feel might the next 2-3 years look like. What this chart represents is a 10-year yield of the treasuries minus the 2-year yield. And the difference is that 0% line. And once this yield, the delta, crosses that 0% line or gets inverted, it's normally an indicator of a possible recession. There's 9 marks on this, red and green. 2 of them, it's inverted and hasn't led to a recession. But 7 out of 9 has led to a recession short thereafter. This is the schedule on the right-hand side of how long thereafter it inverted. We're very close from an inverted yield curve. The average is roughly 14 months. So if you just went off of stats, you think probably a year, year and a half away is something could happen. If they change rates, that does apply to it. But we've a pretty large area of no gray bars. Something possibly can happen, historically speaking, 7 to 10 years, there's normally a market correction of some sort. It may be not as steep as what we've seen previous recessions or corrections, but we want to be mindful of it. As you are evaluating your portfolio now, but into the future, steady as they go is what's important. Because when the market goes down, have the mentality is that it's on sale. You don't go to the mall and find the 110% rack, do you? You go to the mall and find the 70% rack. So think about if you've got longer time frame to invest, you want to buy stuff on sale. So internally, kind of root for markets go down so you can buy it cheaper than it is today. That makes sense? Is this helpful? Has anybody seen this before? No? Okay. We wanted to provide just a snapshot, not to scare you, but just to provide some information of kind of put your emotions in check. Feel free to reach out to us if you want to dive into a little bit more of the analysis as well. A couple final things that we'll end on. We've got a couple minutes or a minute or two. Rollovers. If you've got an old 401k, old IRA at another company, call it being neglected, you have an opportunity to roll that over to the Fidelity plan at Carbon here. It's normally a pretty straightforward process. You call your old provider, they send you a check, you attach a rollover form, and mail it to Fidelity. Fidelity's got a team that can help you with that as well. That's that 800 number there. And feel free to reach out to us. We can talk to you about that process, pros and cons as well. The next page is just going to be a snapshot of what the rollover form actually looks like. So you'll see just a 2-page thing. You'll fill out your contact information, what's enclosed in that check, if it's pre-tax or Roth contributions, quick signature. It does have to get signed by the HR team here. So if you do have a rollover, you've got to send that to them, get them to sign it, and then they have to send it back to you. So a little bit of administrative burden, but they have to verify that you're eligible for a rollover. So that makes sense?
The reason why we talk about rollovers is, having been in this business for a long time, people move, say you left employment and the money gets lost. And I feel bad for people that they come up to us and say, hey, I've worked at this company for like 5 years. I'm pretty sure I had a balance, but I'm not sure where it's at. And that's just be a good steward of your money. So it is most practical to have it in your current employer's 401k plan. They're portable. These are your accounts. So we can try to help you find them, but it's just be a good steward of your money. It makes the most sense to pay attention to it here.
And the fees is there's no cost of transferring it. You're not taxed. You're not penalized. As long as it goes from a 401k account over to another 401k account, it's money in, money out, or money out, money in. The processing company, so your old company, they may have like a $25 to $50 fee just for them to mail you a check and talk to you on the phone, essentially. So they'll normally just take that out of the account balance in that process. Last and final things, our contact information. It's on the bottom of that asset allocation guide. We're going to have quarterly emails that will come out with this asset allocation guide, a newsletter, short video, some market news. Expect to see that kind of mid-July from us, from your HR team as that comes out. and then quarterly thereafter. Again, you're free to reach out to us at any time. We're here for you. If there's any final questions, we want to leave for just a minute or two. Go ahead.
Can you talk about the advantages of recalculating your account?
Yes, a great point. So in Fidelity, in their system, they've got features where you can increase your contribution rate by 1%, but you can also rebalance your investments. So truing up those percentages. So if you're following one of those columns, that 25% number, if the markets go way up in that category, that 25% number may be 30%, or it may be 40%. And what tends to happen is if you let your money just sit there and roll, is that it creates an imbalance over your risk tolerance. So if the equities do really, really good, you're heavy to equities normally. What you can do is just automatically rebalances it, and it just trues up these percentages. It takes the gains off of one and puts it back into the losses of the other, or trues up these numbers. So if this one was, let's say, 30%, you hit rebalance quarterly or semi-annually, it'll sell the 5% and put it to somewhere else that had a lower percentage, and just makes that in line. It's very important to do that. I think the numbers are, with that 300% move up, if you were in like a 60-40 portfolio at the very bottom in 2009, and equities ran up, you would potentially have 90% in equities right now if you did nothing with it. So now you're more aggressive without knowing that. Thank you for bringing that up. It doesn't cost to rebalance at all, and you can set it up to be automatic. Our 2 cents would be due quarterly or semi-annually. My personal recommendation would be semi-annual. I think quarterly is a little short because there's a lot that goes on, throughout the year, but quarterly is a pretty tight window. I would personally do semi-annually to let some of those markets run. So 2 times a year, make sure your account is set up in the correct investment menu.
There's a way to automate your percentage of contribution. We recommend a minimum 6, so you get the full company match. The national average, for what it's worth, is 8. For those of you around the millions of people in 401k plans, that's the national average, is 8%. As advisors, we're going to recommend 10. We know that people at 10% have the most likelihood of a satisfied retirement that they were hoping for. So if you're at 6, also a tool features on the website of Fidelity is that you can go in and bump it up by 1 year every year until you get to 10. You can automate that feature, and because payroll is integrated, it's going to automatically talk back to your payroll system. So if you automate it on the Fidelity website, it'll say on January 1, I want to go from 8 to 9, and then the next year from 9 to 10, and then from 10 to 11. You can just automate that in the Fidelity website. So it's another great feature to get to 10 or higher if you want to go higher too. So know that that's available.
Any other final comments? We want to be mindful of your guys' time. We're at a couple minutes over, but are there any final comments or questions? Awesome.
I just have a comment on the retirement amounts there. In that other box.
Oh.
I was just thinking maybe you guys could put what you were saying, the aggressive, moderate, aggressive.
Oh, as far as
Yeah.
just a detail?
Yeah, just so you can see.
We will definitely add that to the next quarterly
Yeah.
update, some just kind of information refresher on that.
Yeah.
Absolutely,
That
we
would
can
be
add
great.
that. We tend to, just not to talk a lot, but not every 20/40 fund, so there's probably 100 different fund families that have target date funds. Not every 20/40 fund is uniquely the same allocation though. So you could have T. Rowe Price or American Funds or Fidelity. That 20/40 fund may be 50/50 right now, but you have other funds that may be 60/40, they may be 70/30. So it's normally a general thing that say the bigger the year, the more aggressive, smaller the year, less aggressive.
Well, and even if you put moderate and then
Yep.
slash
Yep.
moderate
Yep.
aggressive would be.
Correct, absolutely. So we'll get that added to the next version of it. So, great.
Good.
Great feedback. Well, thank you all.
Thank you all. Appreciate it. Hopefully this was helpful. 30 minutes. We got it done.
Thanks, Mark. Thanks, Dan.